The biggest investment opportunities are rarely in the stocks already making headlines. That's why today I'm digging deeper to help you find 6 under-the-radar tickers with serious upside potential. In every case, our AI-driven quant model has flagged them for genuine 3x potential in 2026. Plus, Wall Street analysts are pounding the table on all 6 given their tremendous growth prospects. And yet, still some investors haven't heard of many of these stocks, which is why I'm so excited to share them with you today. By the way, I'm Steve Reitmeister. Most everyone calls me Righty. I spent over a decade as editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen.com, where I help develop a quant rating system that has proven to beat the market. All the picks today came straight out of this proprietary rating system. Be sure to watch till the end, as you won't want to miss any of these great stocks. All right, before we get into the stocks, please hit that like button. It takes just a half a second and tells me to keep making more videos like this in the future. All right, first up, we have BioCryst Pharmaceuticals with a symbol of BCRX. We are truly starting off with a bang, as this stock has over 270% projected upside potential. Is it too good to be true? After all, the biotech sector is full of landmines. A drug fails in phase 3 and the stock loses 80% overnight. A clinical hold comes through and the company might not survive. Most biotech stories are really just binary bets on the trial results dressed up as an investment thesis. That type of speculation does not interest me, which helps you appreciate that BioCryst is not in this all-or-nothing camp. Their lead drug is already FDA approved and treats a rare and potentially life-threatening condition that causes sudden, severe swelling episodes throughout the body. It's already in the market, sporting increased growth. BioCryst has already taken the clinical risks. The trials are over, the approval was won, and now the company is executing on a commercial operation that is clearly working, with development costs coming down and revenue continuing to scale upwards. This means improving profit margins. Let me give you some exciting numbers. Last year, BioCryst revenue grew 94%. And looking out at the last 5 years, the average annual rate of growth for revenue was 117%. This shows that the growth party is still very much intact. Now, tack on top a healthy profit margin of more than 30%, and you're starting to appreciate the unique attractiveness of these shares. Here's the kicker. BCRX is trading at less than 7 times earnings. As you can imagine, that's an A rating over value, as they are actually in the top 2% of stocks in that category according to the Zen ratings. Combine that with placement in the top 20% for growth and top 1% for financials, and it's clear the company has a lot of fundamental appeal. All this hasn't slipped past Wall Street's attention because there are 6 analysts printing buy or strong buy recommendations. However, most buy recommendations come with just 15 to 20% upside to fair value. That is what makes this stock so special, as this group of experts are projecting on average 150% upside in the coming year, whereas the most optimistic forecast is banking on more than 275% gains for the shares in the coming year. All right, not to be outdone is our second stock in ASRT Holdings with a symbol of ASRT. This is truly a hidden gem, as there is only one analyst covering the stock at this time. Gladly, it is the analyst at H.C. Wainwright, who ranks in the top 1% of his peers for stock picking performance, and his price target calls for 200% upside in the year ahead. Straight off the bat, we have an interesting setup here. The coverage is thin, sure, but someone who's very good at stock picking is pretty confident it's going to be a hit. Being ahead of the curve on the story like this is going to be very profitable. That's because each additional analyst rating down the line would lead to a quick surge in shares. This is a specialty pharmaceutical company with products across neurology, hospital care, and pain management. The drugs are already approved and generating revenue, so that's one major worry taken off the board. Even more impressive are the gross margins running above 68%. What ASRT is doing at the moment is pure commercial optimization, focusing capital on their highest margin products, cutting what does not work, and improving cash flow quarter by quarter. There's no binary clinical trial risk here, no FDA approval overhang, just the quiet, unglamorous work of getting larger and more efficient, which is already showing up in their earnings reports. The Zen ratings also smiles on ASRT with an overall B rating, which is a solid buy recommendation. The component grades also tell an interesting story. In particular, it gets an A rating for growth. This means our system analyzes it through the lens of 22 different growth metrics and then compared it to 4,600 stocks to see how it stacks up. Impressively, it's in the top 5% for growth. That is their business registering real, sustained improvement in revenue, earnings, and margin trends over time. Not a one-quarter spike, but a real, tangible pattern of consistent growth. but we're not going to ignore the downsides. It's a small cap, and like I said, there isn't much institutional coverage, which can lead to a bit of an information vacuum. The safety rating is a lowly D, so if you're not comfortable with extra volatility, this might not be the right pick for you. However, if it does interest you, which makes a lot of sense given the powerful Zen Ratings insight, then I might recommend a smaller than average position given the additional risk. Quick pause, if you're not subscribed to our channel yet, then now would be a good time. That's because we publish stock picks like this frequently, all driven by the same quantitative framework. Hit subscribe and the notification bell so you don't miss any future picks. The next stock is Lands' End. Yeah, Lands' End, like the longtime clothing catalog company. Sounds kind of boring, right? Wrong. Don't skip ahead till you hear this. Analysts project over 190% potential upside in the coming year for these shares. That's because their underlying numbers have been quietly improving for years. Right now, the market is only pricing it at 0.37 times revenue. That's tragically low. It's the kind of valuation where investors are expecting them to disappear. Far from it, okay? First, consider that revenue came in at $1.3 billion last year. Gross margins have been expanding, are now approaching 49%. Digital sales account for a growing majority of revenue, and the B2B segment, like corporate and school uniforms, provides a recurring revenue base they can count on each year. These are institutional customers on annual contracts. They come back because switching is kind of a hassle. Few clothing brands have that kind of built-in revenue. The Zen Ratings also appreciates the fundamental attractiveness of these shares, putting LE in the top 5% of all companies analyzed. Drilling down to the component grades, we once again find strength for growth in the top 10% of all stocks we track. Remember, this goes beyond earnings growth to also show improvements in revenue, EBITDA, profit margins, and cash flow. It may not be explosive growth, but it is real and consistent growth, the type of growth that increases the odds of more earnings beats ahead. When it comes to financials, it's in the top 25% and it's in the top 15% for sentiment. That's a healthy combination of margin expansion, balance sheet discipline, and smart money flowing into the stock. And yet, even with all this flexing of their fundamental muscles, the market is still pricing them like an antiquated dinosaur. This is apparent with the ultra-low PEG ratio of 0.41. This low valuation relative to their impressive growth is why the top-rated analyst sees 190% upside for shares in the coming year. Speaking of tremendous upside, if you want 3 more stocks our model is flagging with similarly strong setups right now, claim your free copy of our special report, 3 Stocks to Double This Year. I'll drop the link in the description below or scan the QR code. Next up, we have OPRX with a symbol of OPRX. Now, I need to note that this stock is down over 6% in the past 3 months. I'll admit that sounds scary, but 2 important things grab my attention to still recommend the stock today. First, top-rated Wall Street analysts believe it has over 250% upside potential in the coming year. Second, the Zen Ratings model is showing an A overall, putting in the upper echelon of stocks we track, scoring the top 4% based on the overall fundamental strength. Here's what the company does. OPRX built a platform embedded inside the electronic health record system that physicians use every day. The platform brings forward relevant clinical information, financial support options, and treatment data, all at the exact moment the prescribing decision gets made. Being integrated into these record system takes years to build out, and the switching costs on the hospital side are substantial enough that customers do not walk away easily. Let's lay all of our cards on the table. The growth prospects, valuation, balance sheet, and analyst ratings are all positive. Unfortunately, momentum is an issue given the 60% drop leading to a D rating in that category. But look at what it has going for it. Top 13% for financials, top 12% for value, and top 6% for growth. That recent 60% drop seems excessive, making right now an interesting buying opportunity. Despite the price action, analysts remain incredibly optimistic on the company's outlook. That's because 5 of the 6 covering analysts still are recommending the shares as a buy or strong buy. Even better is the average 12-month price target pointing to 150% upside, whereas the street high calls for shares to rally more than 250%. The question is not whether the sell-off was painful. That was clear to see. The real question is whether anything fundamental has changed in their growth outlook. So far, the answer appears to be no. Thus, with the Zen Ratings and Wall Street analysts singing their praises, that matters a lot more for investors going forward than the current price chart. Okay, only 2 more stocks to go, bringing us to MNTN, incorporated with a symbol of MNTN. The headline here is that we have a stock with over 150% upside potential, according to Wall Street's best and brightest. MNTN is a performance marketing company for television. Here's the deal. Cable subscriptions have been declining for over a decade. Streaming now demands more total viewing time than traditional broadcasting and cable combined. The audience already moved on. MNTN built a platform that lets brands run performance-optimized campaigns across streaming services and measures results the same way you would measure a paid search campaign. We're talking about real attribution, accurate ROI data, and real-time optimization. It is a tool that makes TV advertising finally accountable. All right. The most exciting detail is that the vast majority of these advertisers never ran TV ads before. That means they're opening up a brand new frontier with impressive growth potential. Not surprisingly, MNTN has an overall Zen rating of A, which of course piques my interest. But what immediately jumped out to me with MNTN is that it possesses a rare combination of a financials rating of A plus a safety rating of B. Very rare and appealing for a small cap growth stock. Last year, margins increased by more than 12%. The company is virtually debt-free, the benefit of which is showing up in their last two earnings reports. First time around was a solid 4-cent beat. Then analysts raised expectations, which they then crushed by 17 cents. This bodes well for future quarters. And did I mention the stock currently ranks in the top 13% for value? That's one of its most important takeaways. One current mark against them is the poor price action since it went public in May of 2025. That includes another 15% drop the past 3 months, much of that coming after the Iran war rattled the market. Wall Street sees an average upside of more than 100%. And this isn't thin coverage either. 8 analysts track the stock. The most bullish forecast sees the upside of more than 150% in the cards. So to sum it all up, MNTN is in a great position to enjoy growth from increased streaming ad spend. This has been showing up in their recent earnings reports, but not the share price. To me, that spells opportunity while the rest of the market is still asleep. Finally, we come to Pagaya Technologies with symbol PGY, which is a profitable and growing AI fintech company. Even better, analysts believe shares could see 200% upside or more in the coming year. Yet here's the real head scratcher. PGY is trading at only 12 times earnings, which is a far lot less than most other AI-driven fintechs with 40, 50, and 60 times earnings valuations. The reason why it's so cheap that has been severely dropping over the last 3 months, down 50%. It wasn't anything specific to Pagaya Technology. Instead, a competitor reported rising delinquencies, and that fear caused a cascade effect in the sector. But the thing is, Pagaya doesn't appear to be at high risk. The company doesn't even hold loans on its balance sheet. Instead, they have an AI model that evaluates borrowers, usually the ones that traditional credit scoring would reject, and then they help banks and other fintech companies extend credit effectively to those customers. For each loan they help get through, they get a fee. There's no credit exposure here. The sector-wide worries just don't apply to Pagaya Technologies. So what's Wall Street's take? They seem to agree with our positive view. That's because all 5 analysts covering the stock have maintained strong buy or buy ratings even through the recent sell-off. The truly compelling part is their average price target, implying upside of more than 180%, while the street high forecast says it will push past 200% gain in the year ahead. These aren't random analysts. They're top-rated experts like John Hecht of Jefferies, who is in the top 19% of all analysts, based on his stock-picking performance. And even better is Joseph Vafi of Canaccord Genuity, who's in the top 2% of all stock pickers. The Zen Ratings quant model also gives the stock another vote of confidence. When looking at the fundamentals as a whole, PGY ranks in the top 20% of all stocks that we track. Then it ticks up to the top 15% as we drill into key areas like value and growth. The price-to-earnings growth ratio is just 0.33, so the stock looks severely undervalued at the moment. And with earnings expected to grow by 38.71% in the coming year, the numbers are not giving the pessimists much to work with. Now, long story short, it's profitable, growing business that's not being properly valued. Word to the wide is consider buying this hidden gem before it's not hidden any longer. There you have it. 6 different stocks, 6 exciting setups where the fundamentals and the analyst conviction are pointing in the same direction. Please leave a comment below and let me know which of these 6 high upside stocks is your favorite and why. And if you think I missed a hidden gem stock, then share the details with our community in the comments section below. If you're interested in high upside potential stocks and want to know a high-flying stock going under the radar right now with better fundamentals than NVIDIA, then check out this next video.